Hello and welcome. My name is Connor Marsh with Excalibur Financial Services. We are a Jacksonville-based money management firm whose founder, Gary Marsh, has been in the business for 35 plus years. Today we'll be discussing the fourth quarter market recap. Most of the data today is being provided by our friends at JP Morgan Asset Management. We always find the information they produce to be very helpful and informative. Here we can see the report we'll be looking at today. As you can tell, it is as of January 1st, 2018, so these are the final numbers for 2017. This is a good report that kind of recaps everything, different sectors of the financial markets, and today we'll be taking a closer look at those we find interesting. Here we can see a breakout of equities and fixed income. Equities have rallied this past year, mostly due to strong corporate earnings and other economic data indicating a synchronized global upturn in growth. A lot of key statistics are looking very strong, not only on the US, but overseas as well. Indexes continue to hit daily records now that we're even moved into 2018, which is also a great sign. For the quarter, the Dow Jones Industrial Average was the #1 performing asset group, returning just over 10.9%, we can see here. The Dow Jones 30 is made up of 30 companies that cover all of the major sectors of the U.S. stock market, except for transportation and utilities. Growth stocks were the second best performer for the quarter at 7.86%, followed by NASDAQ as well. We can also see year-to-date, EM was the best performer at 37.75, followed by growth and NASDAQ. NASDAQ, as you know, is mainly comprised of tech stocks. Moving on to fixed income, we see that returns are positive for the quarter and for the year, but they just have not performed as strongly as some of the equities, which is pretty typical as the two are not correlated. This slide shows the S&P 500 returns broken out into the respective sectors. Tech stocks have done well due to growing optimism and demand, and were boosted by recent releases such as the iPhone 10. Materials were second best. The materials sector is made up of companies that focus on the development and processing of raw materials such as metals, chemicals, and other things of that nature. Followed by that is consumer discretion, basically made up of goods and services that are considered non-essential, such as apparel, entertainment, automobiles, things like that. Defensive stocks, such as utilities, consumer staples, and telecommunications. Utilities, we can see kind of towards the bottom, although most of them are still positive, were not as or did not perform as strongly as technology, materials, and consumer discretion. This chart shows total return for the different sectors throughout the year. As we can see, EM was the #1 performing asset class, as we mentioned before, and is an area that we have chosen to overweight in our portfolios here at Excalibur, and we feel strongly about that moving forward. The next asset class here is DM, or developed markets, which basically made up of Europe, Asia, and the Far East. Some of the more developed countries. EM is more geared towards kind of younger economies, Brazil, China, things like that. And you can see just down through, you have the S&P 500, small cap, high yield, all the way down till we get to cash, which was the worst performer for the year. So it shows to have your money invested and to keep it working for you. It's going to be your best option. Taking a look at key rates, the Federal Reserve did raise rates 3 times this past year, with the most recent one coming just last month in December. We can see here on the 2-year Treasury, it's currently at 1.89, which is up from last quarter of 1.47. So quite a big jump there. And also the 10-year is up at 2.4 compared to last quarter at 2.33. Currently, as it stands, We are expecting 3 more rate increases in 2018, 2 in 2019, and 1 in 2020. As I mentioned in my last video, these are typically made off of inflationary data, and they make sure that things are looking right and moving in the right direction before they do make these increases. And that's typically how they go about it. Our last slide, we're just going to take a quick look at some of the commodities, mainly oil. Oil is up over $60 a barrel right here, up from 51.68 last quarter. OPEC and non-OPEC production cuts of 1.8 million barrels per day are due to last until the end of 2018. This causes oil prices to move upward from 8 consecutive weeks of U.S. crude inventory drops. So we could see a decrease in supply, causing that price to creep up a bit, and you could also see possibly down the line fuel prices to follow, a slight increase there. This is our fourth quarter financial review and our 2017 market recap. My name is Connor Marsh with Excalibur Financial. Please feel free to reach out with any questions about today's video or any other financial related questions you might have. Our number is listed here below, 904-619-5944, or please feel free to look at our website as well, listed below, excaliburfs.com. Thank you, and hope you have a great 2018.